In this lecture, we're going to look at IAS 8, focus on accounting policies, changes in accounting estimates, and accounting errors as well. So this is quite an important standard. When you think of IAS 1 and you think of IAS 8, they kind of come as a package in terms of the presentation of financial statements, which you will have noted when you looked at, for example, Glombia's annual report. One of the first things you see after the financial statements is a list of the accounting policies. So IAS 8 gives you that prescription in terms of disclosing your accounting policies, but also dealing with what happens if we change those or something else happened. We need some guidance and some clarity. Right? So there are choices in certain accounting standards, which are essentially choice in accounting policy. So we know we covered in IAS 40, for example, you can choose between the cost model and the fair value model to measure investment property. Or, for example, in IAS 2 inventory, we know we can measure inventory using the FIFO method, first in, first out, or the weighted average method. So there is a choice there in accounting policy. So we need some idea of, well, what happens if a company decides to change that from the cost to the fair value? We need rules around it. Likewise, financial statements also have a load of estimates. Depreciation is an estimate. The useful life of an asset is an estimate. You have bad debt provisions or estimates. An estimate by its nature is not going to be exact. So when there's a change in an accounting estimate, you change the useful life of an asset, you change your provision for bad debt percentage, we need a rule of how to account for that. And you've actually a lot of this done in AF1. We're just coming back now to where the actual technical guidance is coming from. And probably less frequent, but again, it does appear, unfortunately, and even PLC company, listed companies' financial statements, is an error. What happens if you spot an error last year or the year before? So it is only prior year errors, because if you spotted an error in this year's accounts, well, you can update it before the accounts are published. So what we're interested in IAS 8 is, what happens if you find an error from last year or the year before? It could be a fraud, or it could be an unintentional error. How do you deal with it? And how do you disclose it in the financial statements? And all of those are covered by IAS 8. Right? So it prescribes, remember, prescription means it tells you exactly, here's the criteria for selecting accounting policies, and also here's the criteria for changing accounting policies. So you have to meet certain criteria before you can change from FIFO to weighted average, or from, for example, the cost model to the fair value model. All right. So accounting policies, specific principles, conventions or rules and practices applied by an entity. And they're all the things we've looked at. Your accounting policy around revaluation, your accounting policy which we'll look at around revenue recognition. And they're all disclosed in the first section of your notes in the financial statements. So if you look, for example, here at Glombia's, and we go to the financial statements, and you go back, so that's their balance sheet, straight, statement changes equity, but the last thing then is the notes. Note 2 is summary of significant accounting policies. So that always has to be disclosed, and that's disclosed under IAS 8. Right, so that's an important one that you have a look at. Now, it tells you how they account for each of the items, and it's quite long. Summary of the significant policies, how they account for property, plant, and equipment, how they charge depreciation, so what percentage each year, how they impair assets, how they deal with goodwill, R&D under IAS 38, the useful life for other intangible assets. So they're all disclosed there, and that could run to 10, 12 pages, just depending on how much detail there is. So it's a very important section, and that's mandated by IAS 8. So make sure you have a look at it. If you go to Kerry Group, you'll have the exact same thing. If we go to the financial statements, straight after the financial statements, you will see statement of accounting policies, all required under IAS 8. So that gives you an idea of how they account for them, what the policies that they use. There's a lot of similarities, but in certain standards like IAS 40, there can be a choice. And where there's a choice, you can have the flexibility of choosing and moving from one to the other. So we need rules around that as well. But that's the standard that mandates that. So IAS 1 mandates the financial statements, and then the accounting policies are mandated around IAS 8. And the criteria that are required to change accounting policy is if it's required by an international standard, or the change is necessary to give more relevant and reliable information. So you might remember from AF1 the key qualitative characteristics. It must be relevant, reliable, must be understandable, timely, complete, all of those key characteristics. So you can't just change ad hocly. You must either be mandated because the standard says so, for example, a new standard comes in, or you must be able to justify that it's going to give more accurate information. Right? So that's the logic here. It must give more reliable and relevant information. And this is important now. When you do change an accounting policy, they must be accounted for, if you want to underline it, retrospectively. What that means is you don't only change this year, you change last year's accounts as well. Because when you think about it, in a set of financial statements, if we look again at Glanbia, and we look at their set of financial statements, you always give 2 years. So you can't just change this year's column and change that investment property to the fair value model, because last year's column is still held at the cost model. So they're not comparable. They're on 2 different accounting policies. So when you have that in IAS 8, if you're changing from FIFO to weighted average, if you're changing from the cost model to the fair value model in IAS 40, you must change both years. So you have to what we call retrospectively go back. Means go back to prior periods and adjust it as if it was always applied. So it means you would have to go back to the previous year and say, if we always held the investment property at fair value, what would the adjustments be? So that's an important one, and we'll see in the next example how would that flow through in the financial statements and what would the debit and credit be as well. So retrospectively means not only you account for it this year, you go back and adjust last year's as well to ensure each year's financial statements are comparable. So let's have a look at an example then to see how we'd account for it. So what we're told here is Bloom purchased investment property 1st of January 2017. It's now the end of 2019, so 3 years ago, 2 million. It adopted the cost model and useful life of 40 years. So that means it's going to charge depreciation because it's the cost model of 2 million divided by 40, which is 50,000 a year. And you're told here's the fair value at the end of each reporting period. Now we know if it's the cost model under IAS 40, you still have to disclose what the fair value is, even though you don't account for it. That's a requirement under IAS 40. You're told the retained earnings at the start of the year, so the 1st of January 2019 is the same as 31st December 18, and the profit for this year was 286 using the cost model. And you're asked, during 2019, the management decided that the fair value model would be more appropriate. So that says that you're allowed to do that because it's a choice under IAS 40, but we need to know what would the accounting implications be. So the first thing you have to realize is you don't just have to change in 2019, you have to change in 2018 as well, because you're going to have to compare it back for 2 years like for like. So we need to figure out then the cost was 2 million. And that means we need to know the net book value at the 31st to 12th, 2018. The reason we need to know 2018 is you need to adjust previously, 1 year previous for comparability. So that would have been 2 years depreciation. So we know depreciation each year is 2 million divided by 40. 50,000 per annum is your depreciation. So your net book value at the end of 2018 is 2 million minus 50,000 times 2, which is going to be 1.9 million. So under the cost model, the carrying value of the investment property at the start of the year, which is the end of last year, was 1.9. And its fair value at that date was 2.5 million. So that's an increase of 600,000. Right, so that is important now that you understand that logic. That what you're saying is if you change from the cost model to the fair value model, that would have meant last year the investment property was 600,000 larger than it currently is in the book at. So in 2018, if it was happened, in 2018, the entry would have been debit, investment property, and credit SOPL. 600. Right, but remember, we're not doing the journals for 2018. We're doing the journals for 2019. So how that is reflected in the 2019 accounts is this credit SOPL actually won't be to the SOPL at all. Hopefully it'll allow me to, won't allow me there. It'll be credit instead, credit retained earnings. So your opening retained earnings in 2019 will be 600,000 bigger. Because you're saying if we went back and changed last year, like IAS 8 says, our profits would be 600,000 bigger, and your profit falls into your retained earnings. So your statement of changes in equity would look like this. So statement of changes in equity extract, it would look like your opening balance, 1st to the 1st, 19, would be, as we are told already, 2.8 million. And you would say change in accounting policy. And what you put there is 600,000. So that means you would say restated balance at the 1st to 1st 19 is now 3.4 million. That's the way you would present it. So again, if you're doing a question 1 and you're asked for a statement of change in equity, you better make sure that you understand how to make that adjustment. So this is in the 2019 statement of change in equity, the current year. You're saying the opening balance, assuming the cost model, was 2.8 million. But we know if we went back and changed to the fair value model last year, investment property would be 600 bigger, as would our profits. So that means retained earnings would have been bigger. 2019 profit then, you have to be careful. 2019 profit will no longer be 286. Because if we changed to the fair value model at the end of 19, so fair value at 31st to 12, 2019, we're told the fair value is 2.6 million. So in that case, what would happen is you have an increase in fair value of 100,000 because you're going from 2.5 million, which we've already adjusted for, up to 2.6, and you must add back depreciation. Because what you're saying is, in 2019, because we're now holding at the fair value model, no depreciation should be charged. Yet this 286 was done using the cost model. That means 50,000 depreciation is already in there, so you're going to add back 50,000. So what that means is the 2019 profit is the starting point, which in this case is 286,000, plus the 100,000 fair value gain if the fair value model was held, because we know the fair value gain goes through the P&L, and plus 50,000 for adding back depreciation. So that means your closing balance the 31st to 12, 2019 will be 3836. So that's important that you have an idea. Now I'll show you the debits and credits in a second as well, but it's important to have an idea there of the impact it will have in the statement of change in equity. Whenever you have a change in accounting policy, you put the net. This is what we call the retrospective adjustment. i.e. this is the impact on profits if that policy had been changed last year. The policy changed this year, you just put it through the P&L as normal, updating it, but you have to go back and retrospectively adjust it as well. Right, so if you want to get the net journal here to understand where is the debits and credits coming from, the journals overall, and bear with me, debit investment property, 750, and I'll come back to that and I'll show you where it's coming from. You're going to credit opening retained earnings, 600, like we've done. You're saying the opening retained earnings at the start of the year, that's the adjustments from previous years. And you're going to credit the SOPL 150, which is the increase in the fair value for this year and the add back depreciation. So they two make sense. Where's the 750 coming from? Well, technically in 2019, based on the question, if you go back, they have 3 years depreciation charged, because you're also told in 2019 they've used the cost model. So they have a net book value at the end of 19. The net book value at the 31st to 12th, at 31st to 12th, 19, is going to be 2 million minus 50,000 times 3, because they've charged 3 years depreciation, all 17, 18, and 19. I know we did 2 years up here, but that's because we're looking at the end of 18. They've done it at the end of 19. So the overall adjustment, they have net book value of this, the fair value at the 31st to 12th, 19. We now want to bring it to 2.6. Above, we have to do that in 2 steps. by bringing it to 2.5 first, which gets the 600 gain, and then bringing it up the other 100. And the difference here is you need to bring it up overall 750. So that's quite a tricky one. You need to go back over those to understand the implications of the financial statements. And that's the net journal then in terms of increasing your investment property from 1850 at the end of 19 up to 26 at the end of 19. Some of that goes to opening retained earnings. It doesn't go through the P&L because that's from prior year. And some of it goes through the P&L because that's related to current year. And that's what we call a retrospective adjustment due to a change in accounting policy. Quite a tricky one, but it does come up in exam papers. All right, so make sure you go back and have a look at that in your own time. So there is one exception to this, and we've come across this already, is when you change from the cost model in IAS 16 to the revaluation model, you'll remember we've never gone back and talked about retrospective adjustments because that's actually an exception. When you change from the cost model to the revaluation model in IAS 16 or IAS 38, you don't make the adjustment retrospectively. So you don't go back and adjust prior year, you only adjust the current year and going forward. And we call that a prospective adjustment rather than a retrospective. So that's why you might be saying, well, why didn't we do that for that change of accounting policy? It's the one exception to the rule in IAS 8. So now we're moving on to something called accounting estimates, which again is different than accounting policies. Estimates are really smaller things that are made on a regular basis, updating useful life of property, plant and equipment, provision for bad debts, even the depreciation used. So that's important. Depreciation method used, straight line or reducing balance. That is an accounting estimate. It's essentially about how you're using the asset, estimating how you're using the asset over its useful life. It's not an accounting policy, and they are accounted for differently. So here, what you're trying to look at is you will update your estimates annually, but a change in accounting estimate does not need to be retrospectively changed. So that means you don't need to go back and say, if I change the useful life this year of a piece of equipment, do I need to go back and change it as if it was changed last year as well? You don't. So it's a bit of a simplification. It says you apply it prospectively instead. So that's a nice simplification that makes it a lot easier when it is a change in accounting estimates. And the main estimates you're worried about are anything to do with depreciation, anything to do with bad debts, are all around estimates. So let's take a small little example here then to figure out what we mean by that. So you're told here, Apple reviewed its depreciation at its most recent annual review at the end of December 17, and they decided the change in the useful life was 3 years at the 1st of January. So it cost 3.6 million the 1st of January 2014, and you're told a 10-year useful life at that date. But now they want to figure out how should they account for now in 2017, given this change in accounting estimate. And what you simply do is, you come here, you get the net book value at the date of change at the 1st of the 1st, 17. Because remember, they changed the useful life of the 1st of January. Because that means you don't calculate depreciation for 17 first, because it didn't happen at the end of the year, it happened at the start of the year. So the net book value will be 3.6 million minus 3.6 million divided by 10, because it's 10-year life, and you've all 14, all 15, all 16. So up until the date of change, you had 3 years times 3. So your accumulated depreciation is essentially 360,000 times 3. So the net book value should be 2520 at the date of change. And all you simply do now is depreciation for 2017 will be that divided by 3. That's what we mean by changing prospectively. Go to the date and just go from that date forward. You don't need to go back and change 2016's depreciation or anything like that. You will just charge that for 17, for 18, and for 19. And that will be its useful life complete. So that makes it a lot straightforward. And you've done that already in AF1 and AF2. Think about when you do a provision for bad debts. You change an estimate from 4% to 5%, it goes up or down. You don't go back and change last year's provision. All you do is adjust this year's and move forward. So that's what we call a prospective adjustment. And that's, if that was an exam question, I'd expect you to explain and say IAS 8, the standard, I'd expect you to explain this is a change in accounting estimate, and I'd expect you to do the calculations. So when you're given something like that, don't just give me the calc and say nothing else. You must explain it in terms of narrative format as well. So mention IAS 8, mention your understanding the key concept, accounting estimates, and how that should be accounted for. It doesn't have to be applied retrospectively. It just has to be applied prospectively. And I'm looking for the standard, and I'm looking for those key terms, and of course I'm looking for the calculations. And the journal entry is a simple debit SOPL expense, credit accumulated depreciation, 840 and 840. And it's as simple as that, but where students lose marks is they do not give me the narrative, they only focus on the calculations. So make sure you read the question carefully to get your full marks. All right. That's a good example. So we've dealt with two of them then. We've dealt with change in accounting policies, and we've dealt with change in accounting estimates. The last one, thankfully we don't have it too often, but we still have it from time to time, is a prior period error. Now remember, we're only interested in prior periods because any error in the current period should be adjusted for before the financial statements are published. So what we're interested here is material prior period errors. Now we would have mentioned this briefly before in other lectures and tutorials around what is material. Now every company, they'll release what their concept of materiality is, and it'll be important in terms of audit as well, the concept of materiality. So for example, if you look at Glanbia and you go back to the auditor report, which is always given before the financial statements, they said that materiality used for the Glanbia audit was 13 million, which was based on about 5% of profits or 1% of equity. So if the error is not 13 million, it may not have to be adjusted for under IAS 8. Again, there's a bit of scope in terms of what, if you voluntarily want to put it in, but it just depends the size of them. We're not worried about an error for 20,000 if the company is 200 million of profit. So it's only material errors that you're interested in. Likewise, if you look at the Kerry Group and we go to their financial statements, before that, the financial statements, there's always the auditor report. And we look at materiality here. So you're told materiality here is about 33 million for the consolidated financial statements, which is about 5% of profit. So similar benchmark for those as well. So depending on the size of the business will drive what materiality is. And if you have a material prior period error, you must retrospectively adjust, which is very similar to what you'll have done for change in accounting policy. So you go back to last year's account and say, right, what will the impact on that error have been in last year's accounts? And then you update opening retained earnings. So it will impact your statement of change in equity. So if you have a change in accounting policy, or you have a change in or prior period error, shall I say, both of them will impact opening retained earnings. The only one that won't impact it is change in accounting estimate, because you don't have to go back retrospectively there. So when the error is not material, you can just put it through the current year's P&L. You don't have to go back and adjust prior year, but if the cumulative error is material, because there could be a couple of errors over a number of years, then you must go back and adjust the statement of change in equity, which means adjust opening retained earnings. And the reason you would adjust opening retained earnings is that error impacts previous year's P&Ls. And of course, all previous year P&Ls go to retained earnings. So you're kind of looking at the cumulative adjustment in the opening balance. I think the easiest way to look at this then is, let's look at some examples. So DoubleExit PLC is preparing financial statements for the year end December year 1. When it discovers a prior year error, the financial statements is the incorrect depreciation figure. So it transpires the prior year figure for depreciation was understated, and this is material. So you always watch for that in the exam question. If it wasn't material, you just put it through this year's accounts and increase depreciation. But to fix this error, DoubleExit have increased year 1 depreciation, i.e. this year, with no further adjustments. So read the question then, provide any journal entries, and briefly discuss the impact of the prior period error. So the first thing you have to note here is, if you're asked to discuss it, IAS 8. So you write down, this is an IAS 8 issue, and the key point is, it is a material prior period error. So what you're not allowed to do when it's a material prior period error, you're not allowed to do this. You're not allowed to put it through the P&L for this year. What actually the journal entry would be for Dodgy PLC, quite an apt name, will be to debit retained earnings, which will be the opening balance. And that will be 200,000. And you will credit accumulated depreciation, 200,000. So what they have done is they've debited the P&L this year and credited accumulated depreciation. That is not right. You're allowed credit accumulated depreciation, but you shouldn't debit the P&L this year. You should debit opening retained earnings. Why? Because it's a material adjustment, and that should actually be shown in the P&L for last year. So your P&L for last year will be 200,000 smaller because your expenses will be 200,000 bigger. That means if your profits for last year are 200,000 smaller, your opening retained earnings for this year will be 200,000 smaller. So in the year one statement of changes in equity, in the retained earnings column, you will have opening balance, first of the first, year one, we'll say is X, and you will have what's called prior period error. That's what it's going to be called, and you'll have a note beside that because it has to be disclosed, and that will be just there minus 200,000. And then what will be stated there is restated balance, first to first, year one, and you progress as normal. So that's the way it'll be done in the statement of changes in equity. Your debit opening retained earnings is presented like that. It's actually physically shown on the statement of changes in equity because the users of financial statements want to know why is there a difference between what it was last year and what it is now. And that will explain the difference. You should have charged 200,000 depreciation last year. That means this retained earnings, all else being equal, would be 200,000 lower. Accumulated depreciation, that's just going to be accumulated up. It doesn't matter which year because it's a single line item in the statement of financial position. So that's important that you reference their IS8 and that you show you know it can't be put through the P&L in year one. It should have been put through last year, we'll say year zero. The main reason for that is it is material. So that was one good example. Let's look at another one then, just to consolidate our knowledge in this area. So we're looking at Leo Limited that discovered capital expenditure of 420 on new machinery was expensed. So clearly that's an error, right? And this was last year, because this is 2019 now. So last year they expensed machinery instead of capitalizing. And again, you don't have a choice under IAS 16. It must be capitalized when it qualifies to be capitalized. That's an important one. When the error discovered, they estimate the residual value of machinery was 20 and useful life was 5 years. Full year depreciation the year of purchase. So retained earnings 31st of December 2018. If you want to put there, that's the opening balance in 19 was 4288. And the profit for this year was 31st December was 895,200. So the first thing, think about what's happened now. This is important where students understand. Discuss the required treatment. So look at the language that's given there. First thing you're saying is this is IS8. Right? So I'll write it down to help you along. First thing you're saying when you're doing discussion, this is IS8. This is a prior period error. Now, I've intentionally left it a bit vague because I wanted you to make the call. There's two possibilities here. It's either material or it's not material. Now you have to try and make that call. You can see here, profit for the year is 895. This amount is 420. So this is a material amount. It's nearly half the profit for the year. So how it's accounted for is going to swing. So this is a material error. Thus must be accounted for retrospectively. Right, so it is important there that you use your knowledge of the key standard to say, well, I know I have to talk about is it material or not, because if it's not material, I'll just put it through the P&L this year. So in 2018, this was incorrectly expensed. Right, so what you're going to do is, you're saying in 2018, it shouldn't have been expensed, it should have been capitalized, and you should have charged depreciation. So if we come back, what is the impact then? In terms of 2018, impact of error on 2018. We'll worry about 2019 in a second. Expenses are too high. Profits are too low. So what we're saying, the first thing is your expenses are too high there by 420. So increase profits by 420 because it should not have been expensed. We don't worry too much about debits and credits for a second, just so we understand the logic. We should increase assets by 420. So for all intents and purposes, that is credit the P&L, debit your asset, but that was last year. So it's technically credit retained earnings and debit, we'll say PP. But that's not the full picture yet, so don't worry about the individuals for a second. But a good student remember, but surely if I capitalize that, I should have charged depreciation. So you must increase depreciation. So increase accumulated depreciation, and that means decrease profits. Because remember, we're not interested in individual expense lines. We're only interested, was the profits for last year up or down? Because that means the retained earnings for last year will be up or down. So accumulated depreciation, in this case, will be, what's the depreciation policy? 5 years, residual value 20. It's going to be 400, which is the 420 minus the 20, divided by 5, which is 80,000. Right. Now, the key thing to watch here is your profits, your accumulated depreciation goes up by 80. Your profits then, you're saying, go down by 80 because you're charging expenses. Now, there's a slight complication here. Sometimes you'll see it, sometimes you won't. Why did they give me my tax rate? So say tax is charged on profits at 20%. You will see in some solutions, they'll say, well, if your profits are gone down by 20%, you're actually saving tax as well. So you can, in questions, if you wanted to say, if you said their actual profits are going to go down by 64, because I'm saving some of my tax because I have a larger expense, that will be fine as well. But I said, I'm happy if you said profits go down by 80, that's more than sufficient for this. But that's where the tax rate might come in. That if you're saying if you have lower profits, you'll have lower tax, so you'll actually save. But I said, don't be too concerned about that one. It's not a major thing. Right? So you don't have to worry too much about that. We'll worry about the 80. So what I want to say there is the net impact on 2018 profits will be increase of 420 because it was expensed when it shouldn't, and a decrease of 80 because one year's depreciation should have been charged. So a net impact of 340. That means opening retained earnings in 2019 should be 340 bigger. So that's what we're trying to think. What will opening retained earnings be at 2019? It should be 340 bigger. Right, so again, we're to some extent, just for simplification here, we're going to ignore the tax element. You could bring in tax to say that your tax bill might be bigger because you're adding back an expense, so your tax profits are larger. But I said for now, don't worry about tax. There's no real need to have that in the question. It overcomplicates things. So what we're saying then, if we look at our statement of changes in equity in 2019, the retained earnings column, your opening balance at the 1st of 1st 19, we're told in the question, was 4288,400, and you're going to say prior period error, and we're going to say that's a net impact of 340,000 positive, and you call that restated 1st of 1st 19, and that's going to be 4628. So that's a nice straightforward. I'll give you all the journal entries, don't worry, in a second, but you have to look at the presentation as well. So it's not just about looking at the 420 in isolation. You know, if that was capitalized, depreciation would have been charged. So if we had looked at the 2018 column side by side, you'd have 420 adding back to expenses, and you'd have an asset being increased as well. We'll see those debits and credits in a second. And then the 2019 profit, just be careful now. Think about what happens here. You're told the current 2019 profit is 895,200. But remember, we now know this asset was capitalized. And if it was capitalized, you should be charging a year's depreciation, which is minus 80. Because if the error was corrected, you would charge depreciation 2018 and you charge depreciation in 2019. So in that case, your profits are going to be 815,200, adjusted for depreciation, and we're ignoring tax here. So that will be closing balance 31st to 12th 19 of 5.443 million. Now there's a lot going on there, but it's important to understand the debits and credits that are going on. So if I told you what are the debits and credits then? Well, firstly, you're debiting PP, and be careful, and we'll do separately. Debit PP cost 420,000, right? So that's your bringing in the cost that should have been there originally. Just because it was in 2018, it doesn't matter. They're all going to PP. The only thing that matters current and prior year is, does it go to the P&L or does it go to retained earnings? This can all go in a single line. You're crediting accumulated depreciation, 160. So be careful about that now, because you're crediting last year's 80, 2018 and 2019's. So when you're coming to the end of 2019, that's what will be in your asset section, 420 minus 160. And then what you're doing is, if you're looking at it, you're going to credit opening retained earnings, in this case 340, which is what we've done there. Credit opening, not credit the P&L, and then you credit, sorry, here you debit the SOPL 80 for the depreciation expense for this year, which we put in there. And if you look at that, that's 500,000 on the debit, 500,000 on the credit. So what we're really only interested in for current year, prior year split is the impact on profits. The errors themselves, where they hit other line items, they can be just thrown into the statement of financial position, because it doesn't really matter when it happened, it's still going to be shown up in the same line items. What does matter when it happened is retained earnings, because it either goes through the current year P&L, reflected here, or it goes through prior year P&Ls, which is reflected in a restated opening retained earnings balance. Now, they are important. You go back and practice those. We will have a tutorial on them as well, but they're not easy, right? They take a bit of practice, and particularly the two that require retrospective adjustment, which are a change in accounting policy and also a prior period error. But remember, only material prior period errors, such as the one we had here, we're assuming it is material. All right. So in terms of disclosures, you can have a look yourself. Each of them have their separate disclosures, and a lot of it's just giving the reasons for why you're making this adjustment and the nature of what the change was. So you can have a look through the key disclosures for accounting policies. You always have to try and give the financial impact. Same for the accounting estimate, and same for the prior period error. They're much the same, and they will be cross-referenced to the financial statements. But it's usually given the nature of the change, the reasons for it, and the amount. It's the same in each one, but that's mandated by IAS 8. Right? And what you will often see, and particularly if you look at some of the more recent financial statements out there now, one of the big change in accounting policies that are happening is when new standards come on board. So it's not necessarily changes within or choices within standards like IAS 40 or IAS 2. It could be when they adopt now IFRS 15, which is the new revenue standard, or when they adopt IFRS 16, which is the new leases standard. That technically is a change in accounting policy. And you have to go back and retrospectively change last year and say, what would our financial statements have looked like if we applied IFRS 15 last year, or if we applied IFRS 16 last year? So it does, IAS 8 is quite a common standard because it covers a lot of stuff that are fundamental to preparing financial statements. In terms of FRS 102, overall it's the same treatment, right? So the UK and Irish GAAP, generally accepted accounting principles, they have the same principles as International Accounting Standard 8. So there's no real difference there. So in terms of your references, have a look at question pack 12. We will have a tutorial on IAS 8 as well, so keep an eye out for that. And the best textbook is probably the Darcy one, chapter 22. Or if you want to have a look at the IAS Plus website, it gives a nice summary of IAS 8 as well. And so that was IAS 8, looking at accounting policies, accounting estimates, and prior period errors.